Welcome back to my channel, guys. In my last video, I talked a little bit about how stocks function and what they are. Today, I'll be teaching you about another security called bonds. Dude, what are you doing? No, not that type of bond. Dude, you're weird. Get out of here. Sorry about that, guys. Like I said, I'll be teaching about another security called bonds. So hang tight. As a friendly reminder, this video is not financial advice, nor should it be construed as such. This video is strictly for educational purposes. Bonds are essentially debt securities that corporations or organizations like the government will issue when they're looking to borrow money from individual investors for a set period of time, and they will pay you interest semi-annually or monthly depending on the security over that period of time. To better understand bonds, I want you to better familiarize yourself with a couple of these terms. There are two parties involved with a bond. There is a bond issuer, who is the company or organization that is looking to borrow money in exchange for the bond that they issue. Pretty self-explanatory. And then there are bondholders, who are investors like you and me, who lend the money out and in return receive these interest payments for holding the bond. Each of these bonds have a couple things in common. For example, par value. Par value is the amount at which the bond is issued, also known as the face value. This is the amount that you can expect to see paid back at the end of this period. The coupon rate is the annual rate of interest payments that you'll be receiving, typically on a 6-month or semi-annual basis, but it may vary from bond to bond. The maturity date is the date at which this bond matures. Another way of thinking about that is, when can I expect to see the money I lent out back, and when can I expect these interest payments to stop? And then lastly, and probably one of the more important factors, especially from a risk perspective, is the bond's rating. Think of the bond rating as a credit score. The higher the rating, the more likely it is that you can expect to see the interest payments paid all the way through, along with the par value back at the end of it. I want you to know the term callable. A callable bond is a bond in which the issuer has the right to call it back in so that they can reissue this at a different interest rate. Typically, they would do so when interest rates drop, because they can then reissue a new bond for a lower interest rate, which will save the business cash flow or the organization cash flow. It's important to understand that with a callable bond, the bond holder does not decide when it gets called, so it is a risk to them as the holder. The issuer is the one that decides to call the bond in, and it is a benefit for the issuing party. All right, now that we got that out of the way, let's get into some of the concepts. Because bonds are considered debt securities, they are more subject to and sensitive to interest rate changes. There is an inverse relationship between interest rates and bond prices, and I'll explain that to you here in a second. As interest rates rise, the price of the bonds that are already issued to the public are going to decrease. And the same goes vice versa. As interest rates decrease, the price of bonds that are already issued are going to increase, because they are now more valuable and are paying a higher interest. That's what inverse relationship means. When one goes up, the other one comes down, and vice versa. Let's look at this in an example. Let's say I own a bond that is paying 7% interest and matures in 5 years. Now, let's say that the Fed decides to decrease the interest rate to 4%. Interest rate goes down, the price of my bond goes up. The reason for this is because my bond that has already been issued is paying a higher interest than what new bonds being issued are now going for. So I'm going to raise the price of the bond, because people will pay for that higher interest rate. People will pay more for that. When this happens, bonds are said to be trading at a premium, which means above their par value. As a whole, because bonds are considered a fixed income instrument, they are often looked at as a safer asset class relative to their peers like stocks. But that doesn't mean there aren't risky bonds, and that doesn't mean they don't come with their own set of risks. Let's get into those. Interest rate risk. This is the risk that as interest rates rise, It is forcing the outstanding bonds to continue to trade at a discount, thus lowering their value. Default risk. And this goes back to how important it is to look at a bond's credit rating. The same way that you and me can default on our credit card payment or our student loan payment or our mortgage is the same exact way that these entities or organizations can default on theirs. This is the risk that the bond issuer will not be able to meet the obligation of paying interest or even returning the par value that you had originally lent to them. Governmental bonds are often seen as the safest or highest credit rating of the different types of bonds. And then this is one of the biggest risks associated with bonds is inflation risk. This is most prominent with fixed income securities because you're essentially locking in a rate of return without any indication of what inflation may look like down the line. This is the risk that the interest payments you're receiving and your rate of return is not enough to keep up with inflation and what it may look like down the line, or at least for the set period until maturity. Bonds have their purpose in a portfolio, and it's a great way to provide cash flow and hopefully safety of principal for the bondholder. Similar to stocks, bonds are just one type of the many asset classes out there. When you're looking and deciding where you should invest, it's important you look at the overall portfolio rather than just one account. That's a concept called asset allocation, which I'll be getting into in my next video. So make sure you subscribe and make sure you follow and share this with someone who can benefit. I appreciate all the support you guys have given me up until this point, and I hope you're getting valuable information from this and are having just as much fun watching it as I am making these. Thanks for tuning in. Like always, let's keep getting lit, and we'll see you guys next time.